Welcome to Sheen Research, your strategic partner in uncovering untapped business potential.
Today, we are taking a really focused look at Brookfield Asset Management Ltd., or BAM, as most people know them. We're synthesizing all the crucial data and, the narrative threads from their Q3 and Q2 2025 regulatory filings.
And we're doing this to really understand where this massive global asset manager stands now, especially after that significant corporate reorganization they went through earlier in the year.
That reorganization is really the backdrop for everything we're seeing. It's fundamental.
Absolutely. And our mission here isn't just to, read off the numbers. We want to dissect the qualitative shifts happening on their huge asset management platform. This is all designed to give you a clear, comprehensive understanding of BAM's recent execution.
Right. We want to highlight their strategic focus areas and map out the key financial metrics that are, at the end of the day, driving value for shareholders right now.
It's all about efficiency, scale, and where they're choosing to allocate their capital. So we'll start by looking at Q3 2025 against last year, capturing all the key numbers.
And then we'll pivot to that crucial sequential comparison, Q3 against Q2, to really gauge management's immediate discipline and their forward momentum.
All right, let's jump straight into the third quarter of 2025. Looking at the financial performance highlights year over year, the trend seems unmistakably positive.
It really is. Management delivered a pretty significant increase in overall profitability. If we start with total net income for Q3 2025, that figure landed at $799 million.
And to put that in context,
Well, it's a very robust increase compared to the $614 million they recorded back in Q3 of 2024. So that's almost a $200 million jump in profitability just for the quarter.
and the metric that flows through from that, the one that really matters to shareholders, net income attributable to common stockholders, that saw an even sharper rise.
It did. It hit $724 million for Q3 2025. That's up from $543 million in the same quarter in 2024.
So that's a 33% increase in the income that's directly relevant to you, the shareholder. That's not a small number.
No, not at all. And that strong growth translates directly into a higher earnings per share, or EPS, which is really the key measure of per share profitability. Basic and diluted EPS for both the Class A and Class B shares stood at 45 cents in Q3 2025.
Up from 34 cents in Q3 2024.
Exactly, an 11-cent increase.
Now, here's a little detail that I think often gets missed, but is pretty central to understanding the quality of this EPS growth. We've got this 11-cent increase, even with a slight increase in their weighted average share count.
That's a crucial point. The diluted weighted average common stock outstanding used in the Q3 2025 calculation was 1,632.6 million shares.
Compared to 1,621.8 million in Q3 2024.
And what that little nuance tells us is essential, really. It means the growth in net income was genuine. It was outpacing the structural dilution or the share structure changes that just naturally happen over a year.
So the core asset management business is just generating more profit per share. It validates the whole structure they put in place earlier this year.
Precisely. Now, if we look at the top line, total revenues, BAM recorded $1.2 billion for Q3 2025, which is up from $1.1 billion in Q3 2024.
So steady growth. But the real story for BAM, and management talks about this all the time, is in that non-GAAP measure of fee revenues. That's the engine.
That's the recurring, high-margin, stable engine of the business. Absolutely. The total fee revenues for Q3 2025 came in at $1,429 million, so almost $1.43 billion.
Which is a healthy jump from the $1,213 million in Q3 2024.
A very healthy jump. It's roughly $216 million in additional stable fee income year over year, and we really need to understand where that growth is coming from.
Okay, so let's break that $1.43 billion down. For Q3 2025, what were the main components?
Right. So first, you have the most stable recurring piece, base management and advisory fees. That totaled $859 million.
Okay. Second, incentive fees contributed another $116 million. And third, the fee revenues they get from their equity method investments added a really substantial $414 million.
So those are the layers. They provide the resilience and the predictability to their cash flows.
Exactly. Now, on the other side of that, let's look at expenses. We noted total expenses in Q3 2025 came in at $495 million.
Which, compared back to Q3 2024, was $476 million. So that's an increase of $19 million, or about 4%.
Correct.
Okay, I want to pause on that. A 4% expense creep. We just established that their fee revenues grew by over 17% year over year. What does it signal when your core revenue growth massively outpaces your underlying expense growth like that?
It signals strong operating leverage. This is a critical point for BAM, especially after the reorganization. It implies that the firm is gaining scale, it's gaining efficiency.
So they're just getting more bang for their buck. Far more. They're extracting far more revenue from their existing expense base. For a company of this size and maturity to demonstrate revenue growth so much higher than its cost growth, it shows that the fixed costs of running this massive platform are being leveraged by successful fundraising.
And that's what's driving the higher margins and the profit increase we saw.
It's a clear sign of operational excellence following that big consolidation.
Okay, so given BAM's global footprint, their commentary is always framed by the macroeconomic environment. Let's look at the snapshot they provided as of September 30, 2025.
Let's start with the major non-U.S. markets. In the Eurozone, GDP growth was estimated at a moderate 1.1% for the quarter.
And inflation.
Inflation is expected to move to 2.1% in 2025 and then drop to 1.7% in 2026. So a relatively benign forecast there. And critically, the ECB's short-term benchmark rate was stable at 2.15%, unchanged from Q2.
So a picture of stability and moderate inflation in Europe. Now let's look east. Things were a bit different there, weren't they?
They were. China's real GDP growth was estimated at 4.8% for the quarter. Now, while that's still a strong number on its face, it is a noticeable deceleration from the 5.2% growth they estimated in Q2.
And the prime rate there?
Also flat. The one-year prime rate in China remained at 3%.
So if we put this all together, the key insight is really the moderation of growth in China. And it's not a crisis, but it's certainly less of a macro tailwind.
Absolutely. The Eurozone is stable, but not really accelerating.
So how does this dynamic, this sort of slowing growth in key non-U.S. markets, how does that impact BAM's core investment thesis in alternative assets globally?
I think it actually reinforces the necessity of their strategy. When global economic expansion is slowing, investors tend to get risk-averse. They look for assets that are inflation-linked, stable, and less dependent on immediate GDP swings.
And that's BAM's specialty.
That is precisely what they specialize in. Infrastructure, like regulated utilities, renewable power, long-term contracted real assets. They aren't reliant on, say, rapidly accelerating markets to drive their returns.
Instead, it's about long-term contracts, essential service fees, regulated returns, things that do well even in a mixed, decelerating environment.
Exactly right. This macro backdrop really explains why the growth in their transition and infrastructure funds is so successful right now. It's what the market is looking for.
Which brings us nicely to their core execution segments. Let's start with that growth engine, Renewable Power and Transition, or RPT.
This segment's success is, I think, a defining feature of the third quarter. The fee revenues for RPT increased by $75 million. That represents an astonishing 47% jump in Q3 2025 compared to Q3 2024.
47%, that's significant acceleration.
And that acceleration is fueled by their fundraising success. The fee-bearing capital, the FBC for RPT, reached $68.689 billion as of September 30th.
And that's up from, what, about $58 billion at the end of last year?
$57.57 billion at the end of 2024, to be exact. So that's a $10.8 billion increase in FBC in just 9 months. It shows an enormous appetite from investors for these transition assets.
And can we drill down into the immediate drivers of that fee surge?
We can. The filing specifically highlighted $27 million in incremental fees that came directly from the subsequent closes of their second vintage global transition fund. Plus another $4 million was generated from the first close of the Catalytic Transition Fund, the CTF.
So it's new money coming in the door that's driving this.
Directly. And on top of that, incentive distributions from their public vehicle, BEP Brookfield Renewable Partners, also increased by $4 million, driven by a 5% bump in distributions. These are all high-quality, long-duration fees.
Okay, now let's pivot to their largest segment by sheer scale, the credit segment. RPT might be the fastest growing by percentage, but credit is just the behemoth, isn't it?
It absolutely is. The credit segment's fee-bearing capital as of September 30th stood at $262.764 billion.
Just to frame that, RPT is around $68 billion. So credit is nearly 4 times that size.
It's massive. And that $262 billion is also up substantially from $244.8 billion at the end of 2024. The scale of this segment is just fundamental to their entire platform.
And that massive scale in credit, it provides the platform for them to make these strategic expansions. We saw that right after the quarter closed, didn't we?
Yes, with that critical subsequent event, the acquisition of a 51.29% economic interest in Angel Oak Companies on October 1st. And Angel Oak specializes in innovative mortgage and consumer products.
Feels like a very strategic move.
It's highly strategic. It immediately expands BAM's footprint into specialized credit and mortgage strategies. It allows them to leverage that huge FBC base in the credit segment into higher yield niche products. It's a perfect example of the platform scale enabling immediate surgical growth.
All right, next we have to talk about carried interest dynamics. This is often the most confusing part of the asset management business for people, but it represents that potential for huge rewards or significant pain.
Exactly. Carried interest, which is the share of profits BAM earns when their funds do well, is often very volatile. The unrealized carried interest allocations attributable to BAM were $241 million for Q3 2025. That's a substantial leap from $104 million in Q3 2024.
And the year-to-date figures for the first 9 months of 2025, they really illustrate the complex internal pressures BAM is managing.
They do. Over those 9 months, the overall net unrealized gain was $51 million, which is a marked turnaround from a negative $24 million for the same period in 2024.
But the drivers behind this are what's fascinating because they show this real divergence in performance across different asset classes.
Incredibly so. The positive drivers were incredibly strong. A $210 million gain from their fifth infrastructure flagship fund, and a $121 million gain from their first global transition flagship fund. So infrastructure and transition are clearly performing exceptionally well from a valuation standpoint.
But those gains didn't happen in a vacuum. They were significantly offset by a major headwind.
A very major headwind. A $288 million decrease reflecting lower relative valuations across various mature real estate flagship funds.
Yet $288 million drop in real estate valuation. That is the single clearest signal of asset stress in the entire Q3 report.
Which brings us to an absolutely critical structural detail, the BN arrangement regarding carried interest. We have to pause here and clarify why this structure matters so much, especially with that $288 million real estate loss hanging out there.
Right. Because if BAM were fully exposed to that loss, it would dramatically change the story of the quarter. But because of this BN arrangement, there's a kind of firewall. Can you just walk us through the mechanics of that carry split?
Certainly. The arrangement makes a distinction between new funds and mature existing funds. So carried interest generated by new funds is split 66.7% to BAM and 33.3% to BN, which is Brookfield Corporation.
So BAM gets 2/3 of the upside on new stuff.
Right. It ensures BAM is the primary beneficiary of future growth. But the critical protection mechanism is with the mature funds.
And that's where the real estate funds fall.
Precisely. BN retains 100% of the carried interest earned on the existing mature funds, the ones that were already earning carry before the 2025 arrangement. So because those real estate funds seeing that massive valuation decrease are defined as mature funds, BAM's direct exposure to that specific loss is significantly mitigated. It's effectively insulated by that BN arrangement.
So the $288 million valuation drop in mature real estate is a strong signal of market stress in that sector. But the actual financial hit to BAM's bottom line is structurally contained.
Mm-hmm.
That clarity is what the 2025 arrangement was all about, wasn't it?
It's exactly what it was about. It allows BAM to focus its investor narrative on the high-performing new funds like infrastructure and transition, which saw those big gains while the legacy issues are ring-fenced.
It's a form of risk management built right into the corporate structure.
That's a perfect way to put it.
Okay, beyond the portfolio performance, management took some very concrete actions in Q3 to prepare the balance sheet for whatever comes next.
Yes. The key corporate event in Q3 was the strategic decision to increase their revolving credit facility capacity by $300 million. That raises the total facility to $1.05 billion.
That's a clear move to bolster financial optionality.
It is. And critically, this entire facility remained undrawn as of September 30th, so they secured the capacity without actually spending the cash. It's pure dry powder.
And as we detailed, the major subsequent event right after Q3 was that Angel Oak acquisition on October 1st, further expanding their specialized credit capabilities.
And we have to just keep reiterating the foundational context here. the 2025 arrangement. That transaction, completed on February 4th, saw BN transfer its, approximate 73% interest in the asset management company to BAM.
In exchange for nearly 1.2 billion new BAM Class A shares.
Right. And this was the necessary step to consolidate the asset management business entirely under BAM.
So why was that structural change so important for how the firm operates and reports to shareholders now?
Well, it achieved three main things. One, unification. It created a pure-play asset manager focused only on fees and capital deployment. Two, governance. It simplified the lines of authority. And three, clarity. It's allowed these Q2 and Q3 financial statements to show much cleaner, more integrated results.
It basically got rid of all the complex intercompany mechanics that used to exist between BAM and BN.
It did. Outside of that specific legacy carry arrangement we just discussed, it made everything much easier to understand.
All right, let's talk about their capacity for future deal making. We can look at capital availability on two levels, right?
We can. First, there's the total group-level firepower.
And that figure is just enormous. The total deployable capital across the entire Brookfield Group, including all the affiliates, was $160.387 billion as of March 31st.
And this total war chest is primarily composed of corporate liquidity, but the bulk of it, a staggering $96.261 billion, is uncalled private fund commitments.
So that is the definition of dry powder. It means they have nearly $100 billion committed by their investors, just ready to be deployed when BAM sees an opportunity. The scale is immense.
It is. Now, for BAM specifically, their own financial strength is measured by corporate liquidity, and as of September 30th, BAM's own corporate liquidity was stable at $1.5 billion.
And that $1.5 billion is made up of two parts.
That's right. $490 million in cash and short-term financial assets, and $1 billion in undrawn credit facilities. And remember, that credit facility capacity was just boosted by $300 million in Q3.
So they're focused on financial flexibility over just holding a ton of cash on the balance sheet.
Exactly. Now let's track the flow of funds during Q3. The filings showed some significant capital outflows, totaling $5.1 billion. Where did that money go?
That $5.1 billion was largely driven by two specific things: maturities of annuities within their BWS insurance capital, and redemptions within the firm's liquid and perpetual strategies.
So this is the natural cycling of capital within their large insurance and public fund platforms.
Right. But they balanced those outflows with strong distributions back to investors. BAM executed $6.2 billion in distributions during the quarter.
Yes, and the key drivers there were $1.8 billion return from real estate and infrastructure flagship funds, and another $1.5 billion from other long-term private funds.
So that signals the firm's continued ability to monetize mature assets and successfully return capital to their LPs, keeping the whole cycle moving.
It does.
Okay, even with strong fee revenue growth, a business built on fee generation has some inherent risks tied to market valuation. What was the core market risk they highlighted in the Q3 filings?
The primary market risk is pretty consistent with prior periods, and it's specific to their public affiliates. BAM's base management fees are directly sensitive to the trading prices of their publicly listed permanent capital vehicles.
So BEP, BIP, and BBU.
Exactly. Brookfield Renewable Partners, Infrastructure Partners, and Business Partners. If the trading price of those public vehicles drops significantly, the fee-based BAM collects from them drops right along with it.
So their core recurring fee stream is vulnerable not to a lack of fundraising, but to public equity market sentiment about their listed affiliates.
That's it in a nutshell. If, for instance, there was a sudden and sustained market correction affecting infrastructure stocks, BAM's base management fees would take a hit, even if the underlying assets were still performing perfectly well operationally.
And what about currency risk? They have a huge international portfolio.
Well, the foreign currency risk exposure is noted as limited. The key reason is structural. The majority of their private funds and their fee revenues are contractually denominated in U.S. dollars.
So the core business is dollar-centric.
Very much so. They do note that they use standard hedging techniques, forward contracts and the like, to mitigate exposure when they have meaningful investments in non-USD currencies, but it's a selective process.
Okay, so we've established the strong year-over-year growth and the operational context of Q3. Now let's zoom in on the immediate momentum. Comparing Q3 2025 directly against Q2 2025 should give us the clearest picture of management's immediate execution.
Right. And starting with revenue and profit trends, the sequential momentum is undeniable, and the profit surge is particularly impressive. Net income attributable to common stockholders increased from $620 million in Q2 to $724 million in Q3.
That's a sequential jump of $104 million in common stockholder profit in just one quarter. But what really surprises me and what highlights their focus on efficiency is the expense side of the ledger.
This is, I think, maybe the most impressive point of the entire quarter-over-quarter analysis. Total expenses actually decreased sequentially. They dropped from $557 million in Q2 down to $495 million in Q3.
Wait, that's a $62 million reduction in quarterly expenses?
It is.
How does a massive expanding global operation reduce its total quarterly expenses by that much while at the same time increasing revenues and total FBC? Is this a sign of the 2025 arrangement really taking hold, or are they just deferring costs?
It's strong evidence of the operational discipline that followed the reorganization. The expense reduction is a very clear marker of improved margins and efficiency. It suggests that eliminating the complexities and overlaps between the prior structures of BAM and BN has led to genuine cost savings.
And almost immediately.
Almost immediately. The slight sequential revenue increase from $1.1 billion in Q2 to $1.2 billion in Q3, combined with this sharp expense discipline, is the mathematical driver of that strong profit surge. This is where you really see the operating leverage kick in.
Okay, let's revisit the external environment for a second. While the overall sentiment was stable, that subtle shift in the macro outlook from Q2 to Q3 is important, isn't it?
It is. In the Q2 commentary, the estimate for China's real GDP growth was 5.2%. By the Q3 filing, that estimate had dropped to 4.8%.
That 40 basis point drop is a meaningful guidance revision. It suggests deteriorating growth expectations in a critical foreign market.
Right. It indicates that the slight cooling trend we saw in the first half of the year really solidified into a lower growth forecast by the third quarter. This just reinforces the need for BAM to focus on internal growth drivers like closing new fund vintages, rather than relying on external macro tailwinds.
So they're managing the business, assuming continued deceleration in some of these key foreign markets.
It certainly looks that way.
Let's drill deeper into that $62 million sequential expense drop. Where specifically did the savings come from in the cost structure?
Well, the largest component is usually compensation and benefits. And here, we also see a sequential decrease. It went from $404 million in Q2 down to $379 million in Q3.
So a $25 million decrease right there. That's a notable short-term success in managing core costs.
It is, but there's a critical nuance we have to highlight, because the filing also notes a year-over-year complexity. The Q3 commentary pointed out that compensation increased by $53 million relative to Q3 of 2024.
And that was driven by a $30 million increase in share and performance-based compensation because BAM's share price appreciated.
Exactly. So on one hand, the cost of compensating employees based on market performance is rising year over year, which is a sign of success. But on the other hand, the sequential cost management of the underlying operational expenses, salaries, overhead is tightening.
So they're showing excellent financial control. They're letting market-linked costs rise, but actively trimming operational expenses.
It's a very disciplined approach. Now, we also need to look at carried interest allocation compensation. This metric can fluctuate dramatically based on valuations.
Right. So what did that look like?
In Q2, the carried interest allocation compensation was a net expense of $16 million. Over the 9 months ended September 30th, so year to date, the total realized and unrealized allocation compensation reached $142 million.
So that year-to-date trend, which is performance-linked compensation, is rising rapidly.
Very rapidly, driven by the strong valuations in those newer funds, like infrastructure and transition. And this expense is also linked to that BN arrangement, where this compensation is recovered from BN for the mature funds, maintaining that firewall we talked about.
Okay, let's talk about market trends. The narrative seemed to shift pretty meaningfully from Q2 to Q3.
It did. In Q2, the focus was heavily on transactions and expansion, things like stepping up their ownership in Oaktree and investing in Castle Lake.
But the Q3 report pivots sharply. Instead of external transactions, the focus shifts squarely onto internal fund valuations and the divergence of performance between sectors.
That's exactly right. The most stark evidence of this shift is that highly specific disclosure in Q3 about the large unrealized gains, the $210 million from infrastructure, the $121 from the transition fund, being explicitly and numerically offset by that massive $288 million decrease in mature real estate valuations.
So this change suggests a market where fundraising is still going strong, but where asset valuations are under a lot of pressure, particularly in real estate. The story evolves from BAM is buying things in Q2 to BAM is managing valuation divergence in Q3.
And it confirms that their diversification benefits aren't just a theory on a page, they're an absolute necessity right now. The strong performance in the newer, high-growth, long-term contracted assets is crucial to absorb and, frankly, mask the systemic pressure being felt in older, mature asset classes like commercial real estate.
Looking at management execution, we see a clear pattern of actively managing their capital base. They were recycling capital in Q2 and then expanding capacity in Q3.
Yes, in Q2, we saw some notable capital recycling activity. For example, the disposition of BAM's interest in the Redwood Evergreen Fund LP generated $237 million.
And that helped fund some of their other investments.
It did. It helped fund net cash outflows from investing activities that totaled $255 million, which also included the investments related to that Oaktree step-up and the Concora deal.
Then, in Q3 and immediately after, the focus shifted to strategic expansion. Management increased their dry powder by expanding that revolving credit facility by $300 million to $1.05 billion.
And of course, the acquisition of that 51.29% stake in Angel Oak was finalized just after the quarter ended. The conclusion here is clear. Management is highly opportunistic.
They're actively selling mature assets to realize gains in Q2 and then immediately allocating capital to expand strategic capacity and acquire specialized growth platforms in Q3. It shows a very intentional and agile capital deployment strategy.
It does. And shareholder returns and their dividend policy are central to investor confidence, especially for a firm that pays out such a significant portion of its distributable earnings.
Right. The Q2 filings highlighted that dividend distributions resulted in cash outflows of $1.4 billion for the first 6 months of the year. And that figure itself was a 15% increase compared to the first 6 months of 2024. So they set a clear, accelerating growth trend for returns.
And the Q3 dividend declaration just confirmed that consistency. They declared a quarterly dividend of 43.75 cents per share, which was paid in June. This consistency is backed by their explicit policy of intending to pay out approximately 90% of distributable earnings quarterly.
But is that 90% payout target sustainable? Especially when we consider the macro deceleration in China and that specific $288 million stress signal coming from mature real estate. Doesn't that policy imply an aggressive confidence that might be challenged?
That is the critical question, isn't it? Management's unwavering consistency in affirming that 90% target serves as a very strong implicit statement of confidence. They are betting that the massive and growing fee revenues, particularly in RPT and the stability of the credit FBC, will continue to generate enough distributable earnings to meet that target.
So they're betting they can do it regardless of the temporary volatility in asset valuations or the stress in real estate carry.
The dividend policy itself is basically acting as an implicit form of forward guidance. It signals internal resilience.
Structurally, the integration from the 2025 arrangement continues to simplify the balance sheet and the relationship with their affiliates.
We noted earlier the $175 million decrease in amounts due to affiliates in Q1. This is just the continuation of that simplification process designed to improve clarity and reduce complex affiliate transactions flowing through Q2 and Q3.
And on the funding side, the distinction between the Q2 debt issuance and the Q3 credit facility expansion is important to contrast.
Indeed, Q2 saw BAM complete its inaugural fixed-rate debt offering, issuing about $750 million of 10-year bonds at a fixed coupon of 5.795%.
So they secured long-term funding stability.
Right. Then in Q3, the focus shifted entirely to flexible capacity with the credit facility expansion, increasing the size of their revolver to $1.05 billion, which draws down a floating rate.
So in Q2, they locked in stable fixed-rate term financing, and in Q3, they boosted their flexible short-term deployment capacity.
It's a deliberate strategy, matching the stability of their long-term asset base with flexible capital that's ready for opportunistic deployment.
And we can't forget Oaktree. The Q1, Q2 period included the acquisition of an additional 1.5% interest, right?
Right, increasing BAM's ownership to about 74% for a net cost of $70 million. And the Q3 report updates the value of the 74% interest to $4.7 billion, up slightly from the end of 2024. So even if Oaktree's earnings were a bit lower in Q3 due to less carry, the underlying valuation continues to trend upward.
Okay, looking at key metrics, we see rock-solid stability in the absolute liquidity number, but a big change in the optionality available to management.
That's the crucial distinction. Corporate liquidity remained completely stable at $1.5 billion in both Q2 and Q3. It's a stable base of $490 in cash and $1 billion in facilities.
However, the revolving credit facilities capacity increased from the $750 million issuance in Q2 to $1.05 billion in Q3.
And this is a signal that management prioritized enhancing their strategic dry powder availability by $300 million without actually needing to draw down the cash. It shows a balance sheet strategy focused on positioning the firm for large, opportunistic transactions that require immediate financing while maintaining a lean cash balance.
It's a sign of very high confidence in their operational forecast and their access to capital markets.
It is, and that flows right into the implied tone and confidence of management. It's visible through their capital allocation decisions and their fundraising success.
That willingness to increase the revolving credit facility capacity to over $1 billion is a strong, tangible sign of high confidence. They believe they can deploy that capital effectively and profitably in the near term.
Furthermore, the continued success in fundraising, which you can see in the financials, the continued closing of flagship fund vintages, especially in the RPT segment, which generated a substantial $37 million in incremental catch-up fees in Q3. It signals that the market views BAM as a highly reliable counterparty.
They're hitting their milestones and successfully converting those milestones into immediate fee revenue. That reinforces the confident tone.
It does.
Okay, let's talk about risks. We already noted the consistent, ongoing risk regarding base management fees being tied to the trading prices of their permanent capital vehicles. But comparing Q2 and Q3, was there a change in how they discuss specific asset class risks?
Yes, the focus became much more explicit. The Q2 report was broader, but the Q3 report really pinpointed the vulnerability. The most pronounced sequential change is the numerical evidence of specific asset stress.
The $288 million decrease.
Exactly. That explicit $288 million decrease in unrealized carry allocations attributed to lower relative valuations across mature real estate flagship funds is the filing's way of stating an elevated sector-specific challenge.
So that numerical disclosure serves as a clear, unvarnished risk signal. It confirms that their financial results depend heavily on the resilience provided by their diversification. It's forcing them to lean harder on the strong performance of their infrastructure and transition books to mask the stress in real estate.
And this shift in emphasis confirms that managing this internal asset divergence is now a major management priority. They aren't just reporting general market volatility, they're reporting sector-specific valuation headwinds that have to be actively navigated.
All right, let's synthesize all these findings. The backdrop for all the strong results we saw in Q2 and Q3 is that dramatic structural change from earlier in the year.
The central role of the 2025 arrangement really cannot be emphasized enough. That transaction on February 4th, where BN transferred its interest in the asset management company to BAM, it achieved its goal. It created a unified, focused, pure-play asset management entity.
And it provided the structural foundation for the improved operational efficiency we saw in that Q3 expense reduction and the clear, integrated financial reporting that allows us to distinguish the core fee growth from the carry volatility.
Looking ahead, the two primary strategic focus areas are clear, and they seem to be executing well on them. First, renewable power and transition.
RPT.
Right. The continued success in fundraising, the subsequent closes of the second vintage transition fund, the first close of the CTF, is driving spectacular fee revenue growth, specifically that 47% increase year over year.
This segment is clearly benefiting from the global shift to decarbonization, and BAM is capitalizing on that trend with high-quality fee-generating products.
And second, credit growth. With fee-bearing capital already massive at $262 billion, the strategic expansion into specialized credit products via that Angel Oak acquisition signals a strong commitment to enhancing margins and product offerings within this, their largest segment.
Finally, we have to understand how management wants us to measure their success. Which brings us to the significance of non-GAAP measures, like fee-bearing capital and fee revenues. Why are these the metrics they always emphasize?
They're crucial because they offer a consistent, predictable view of operating performance. By focusing on fee revenues and FBC, BAM deliberately excludes the high volatility that comes with consolidated fund revenues and critically realized and unrealized carried interest.
So in essence, FBC and fee revenues tell the story of the stable, high-margin engine. And this focus is strategic, especially given that explicit disclosure in Q3 about the large, unrealized carry losses in mature real estate.
Exactly. By prioritizing the narrative of fees and stability, management steers investor focus toward the predictable growth of the fee-generating business, rather than the quarterly fluctuations in asset valuations that are so much harder to predict and control. It's a deliberate effort to manage expectations and highlight the quality of their recurring cash flow.
So to synthesize our core findings from the Q2 and Q3 2025 filings, BAM is demonstrating exceptional execution after the reorganization. We've confirmed significant, quantifiable growth in fee revenues, particularly within the RPT segment, which saw that incredible 47% fee revenue increase year over year.
And on top of that, management is strategically reinforcing its financial flexibility. They're strengthening their balance sheet capacity by increasing the revolving credit facility to $1.05 billion. They're demonstrating operational efficiency, shown by that sequential $62 million drop in total expenses, even while they're grappling with mixed signals in global markets and those persistent valuation pressures in mature asset classes.
It's a picture of an agile, financially disciplined asset manager that's building optionality for the future. They are successfully navigating asset divergence and capitalizing on the structural benefits of the 2025 arrangement.
Which brings us to the final thought we want to leave with you. We've established that the fee-bearing capital in the credit segment is by far the largest at $262.764 billion. And the Q3 report was crystal clear about a major external stress signal. That $288 million decrease in unrealized valuations in mature real estate.
Considering BAM's aggressive moves to expand its credit platform to specialized areas, like the Angel Oak acquisition, the question is about risk correlation. How effectively can BAM continue to manage the internal risk relationship between its largest FBC-based credit and the real estate exposure it manages through its funds?
The real estate loss signals systemic pressure in that asset class. And while the BN structure mitigated the direct carry impact on BAM, the question remains whether the immense growing credit book, which often uses real estate as collateral or is linked to property performance, can remain truly insulated from those same valuation headwinds. The correlation, or lack thereof, between the stress in mature real estate funds and the stability of the rapidly growing $262 billion credit book. That will be the true test of BAM's diversification thesis beyond 2025.
With that, we conclude our coverage for this video. Thanks for joining us. Shin Research. Mindful markets, measurable meaning.